We ready to go?
Yes, we are live, sir.
Okay, great, great. Thank you so much for joining us. Happy New Year to everyone. We're really excited about 2025. Our book, When Markets Speak, How to Listen When Markets Speak, is one of the top bestsellers globally. Thank you so much. We're getting a lot of great recommendations on the book. People love the content. It connects, don't forget the Lehman Brothers response. Our first book was published in 12 languages. It's a colossal failure of common sense. It's a CFA Institute bestseller all time. But the point of that book is that the fiscal and monetary response to Lehman was about $4 trillion. And the fiscal and monetary response to COVID and the regional bank crisis of 2023 has been about $16 trillion. And we wrote a blog, which was featured New York Post, the Zero Hedge. Craig Shapiro's here. He's really helpful. And we wrote a blog within the last couple of weeks, kind of recapping the book and also bringing people into what's happening now. The Biden team on their way out has jacked up spending. The amount of spending in that first quarter of the fiscal year this year, the Biden's basically having Team Biden, don't forget, Team Biden spending money in the first Trump year. That's the way the fiscal year works. So they're spending close to $800 billion. An amazing stat, close to $23 trillion of treasury bills and T-bills were issued last year. And so, in other words, they're jacking up spending as they're going out the door of the Democrats, which is fine. That's their title to do. But they're issuing so many short-term securities. Craig has written about this in terms of the RRP. And all of this tension with the bond market, including what's happening in the United Kingdom, is starting to impact equities. Don't forget, a point that we make in the book, baby boomers today control $79 trillion of wealth. 79 trillion. And the oldest boomers are turning about 79 years old. And so as bond yields go up, it's much more attractive for that large group of wealthy investors in the United States. Bonds become more attractive relative to stocks. Never forget the rule of 72. Never forget. A 6% return in a tax-deferred account, your money doubles every 12 years. And so it's as bond yields go up, they become very attractive relative to equities. You can double your money with 6% in a tax-deferred account in 12 years. I mean, that is like an equity-like return. And so as bond yields go up, it has a lot of impact on equities, especially right now. I want to bring in Craig Shapiro. Craig, one of the things, so we run a Discord chat. People have to reach out to us. Anybody that wants to be in our Bloomberg chat or the Discord chat, it's Tatiana at thebeartrapsupport.com. Tatiana at thebeartrapsupport.com. One of the things that Craig Shapiro has been all over is the RRP. And when we talk to most of our clients are institutional investors in over 20 countries. And when we talk to investors globally, there's more and more concern about the RRP being drained because that's been a big provider of buyers for the T-bills. Don't forget, we issued 23 trillion of treasuries, bonds, and T-bills last year. Yellen's financing that debt on the front end of the yield curve. Very, very dangerous. And the RRP, Craig can explain this, that's been supporting that. Craig, are you there?
Yeah. Hey, Larry. Thanks for having me. Happy New Year.
Happy New Year.
But yeah, Yellen has been, look, her boss is Biden, right? And the Democrats and the party. And she did, I think, reflecting back, we wrote about this in the blog, is, she did what she, did last year with respect to issuing more T-bills than long duration securities, despite an inverted yield curve, despite low term premiums, because she was trying to get her team reelected, right? She tried to keep the economy running very strongly. She tried to keep the markets afloat. And so can we blame her for that? I don't know. I mean, yes, we could blame them for doing that, but that was kind of her job in the end. And so we could be critical, but really, ultimately, Republicans won and Trump won because folks are upset about inflation, right? And they are upset about the fact that the Fed and Treasury have not been able to bring prices down and bring the rate of inflation down. And Yellen's decision to issue more cash-like bills as opposed to bonds really exacerbated that inflationary concern. And so ultimately,
And correct. So that's why what blows my mind when when you ask investors is 23 trillion. What blows my mind, and think about it, there's a lot of 8-week bills, 4-week bills. So they're borrowing money for 4 weeks, 8 weeks. So that's why if you add up the total issuance, it gets up near 23 trillion in 1 year because they're issuing so many 3 months. They're borrowing money for just 3 months, 6 months. And but get into what I hear from the institutional investors is this growing concern about the RRP, how it's being drained. Explain what the RRP is and how it helps the T-bill market.
Yeah, I mean, basically the way to think about it was the RRP is a place that investors could park money with the Fed for an overnight rate at a very attractive, very high yield, basically based on where the Fed funds rate is. And that money, acted as a buffer, from the spending that was done post COVID and the deficits. And so not all that money kind of made its way into the economy. Some of it kind of went into bank reserves and then went into the RRP. And so it was a buffer for the economy. As issuance has grown and this T-bill issuance has grown, that money has been drained. I think it was a way to sterilize the deficits.
So if T-bill rates are here and the RRP is here in yields, money's just going to leave the RRP and go into T. So as they issue lots more T-bills to fund this big blob of spending, like I said, 16 trillion of fiscal monetary response to COVID and the regional bank crisis, and they juice the spending into the election. So if T-bill rates are here and the RRP is here, it drains the RRP.
Right. And so we've taken over $2 trillion out of the RRP facility over the course of the last 18 or so months. And so now we're running kind of sub $200 billion. So there's not a lot of money left in that facility. So there's not a lot of excess liquidity kind of sloshing around, which means that as we go forward and Treasury has to issue more debt, which they will, probably another 2 trillion of deficits this year, we need to find the money from somewhere else. And it's going to come from private sector balance sheets at banks and folks that own assets, right? And so as the Treasury issuance grows, that money needs to come from somewhere else, and it's going to come from a risk investor's portfolio. And as yields are higher, as you mentioned, the 10-year, 30-year yields approaching 5%, that money's going to come out of other places and find a way into 30-year notes and other longer duration securities. That's part of the pressure that I think we're going to start seeing on the equity market, and maybe has started to see over the course of the beginning part of this year.
Exactly. Bonds have never mattered more for stocks, right? I should say never, but you got to go back to maybe 2007, 87. It's what happens. There's a Rubicon where it crosses, and all of a sudden bonds mean a lot for stocks in terms of where the money's going to go, in terms of valuation. Stocks have never been this rich relative to bonds, what they call the risk premium. Now, Craig, you put a stat in. So like I said, we run a Bloomberg chat with hedge funds, mutual funds, and pension funds. And Craig runs our Discord chat with families and high net worth individuals that are not on Bloomberg. So please join us, Tatiana at thebeartrapsupport.com. But Craig, you've been making a point around, so 25% of the U.S. debt rolls over this year, 25%, which is a big number. So of all the debt that has to be fixed, 25% rolls over this year. But you made the point in a chart that 40% of the 25 is in the first quarter.
Right.
So what's happening, ladies and gentlemen, is that people know, this is well known. This is the New York Post, Zero Hedge has done a great job. This problem is well known. So some hedge funds are maybe shorting bonds into bond issuance. Everybody knows the first quarter is going to be rough. If you look since 2021, February has been the worst year seasonally for bond issuance. And so the last 3 or 4 Februarys and Januarys have been very rough. So Craig, walk us through the Trump team's coming in. Percent probably needs to start terming that debt out, issuing longer dated paper. That puts even more pressure on these yields. This is well known, though. This is well known. But explain what's happening with the issuance the next couple of months. And if the RRP is so low, then all of a sudden we need real bond buyers, right? We need real bond buyers.
Yeah, I mean, Scott Bessent and Steve Moran, who's going to run Council for Economic Advisors, have both been, hypercritical of Yellen's decision to finance the debt with T-bills, particularly in an environment of low term premiums or negative term premiums, which we had up until the last, few months or so, and an inverted yield curve. There was incentive actually for Treasury to be borrowing long, right? Long duration. There was an incentive. It was cheaper for them to be issuing 10-year paper, 20-year paper, 30-year paper, and she decided not to. And that has to do with, like we mentioned earlier, this effort to maybe keep markets afloat. And so Bessent had been very critical of that. And so as he gets into the seat, his first meeting is the end of, provided that he's confirmed, as I suspect he will be, his first meeting will be the end of January, where he gets to decide kind of what the next 3 months of issuance will look like. It's unlikely that he's going to change much from because he's just going to get into the seat. But as you think about the rest of this year, he's going to need to be making decisions about terming out the debt, for longer periods of time. That's going to put more pressure on these long end yields. And so
let's bring in some slides while we're at
it. It's complicated a little bit as well because this saga around the debt ceiling too, which we kind of need to talk about. And the Republicans do control all three branches, here, the House, the Senate, and the White House. So, but as of right now, as of next week, we are going to trigger the debt ceiling limit, which means Treasury cannot do any more net borrowings, right? So they can replace this 25% of borrowings, this 9 trillion or so that needs to be refinanced in the first quarter of this year. They can replace it, but they can't add to that deficit. And so what's going to wind up happening is there will be net bill reductions over the course of the next couple months. And so money is going to kind of be sticky in the RRP, right? Because the yields in the RRP are still, fairly attractive. But as they need to issue these longer duration securities, they're going to have to find buyers for them. And so the bond market is starting to wake up to that. That's part of the reason why long end yields have moved so aggressively over the course of the last 3-4 months since the Fed has cut rates, right? The Fed cut rates starting in the middle of September with a 50 basis point cut and has cut 100 basis points off the Fed funds rate. 10-year bond yields are up over 100 basis points since the Fed started cutting rates.
Right. Jose, if you could bring in the UK, but remember, Craig, you've been making this point, and it's really, I want to pound this home. So this is a US rates thing, but also it's gone global. So one of the things we talk about in our book, How to Listen When Markets Speak, is the amount of bonds that are being kind of issued globally relative to the United States. And so in the United Kingdom, to think of this, for example, in the United Kingdom, the pound's down 8%, like, was it 3 months? The pound's down 8%. But oil prices since, there's the pound. Thank you, Jose. So we're down. So think of, like, imagine if you're in the United Kingdom and you need to buy energy. Energy's priced in dollars, so you get a weaker pound. Since mid-September, oil's up 13%. Natural gas is up 70%, 70. So energy importing countries, Craig, you made this point in a post yesterday. Energy importing countries, the United States is now exporting inflation, because if you think of the Bank of England, they thought they had, they've been trying to fight inflation. Same thing with the ECB. Now all of a sudden, their currencies have imploded. Energy prices are up. So if you're trying to buy oil and gas with a weak currency, the U.S. is actually exporting inflation to these countries. Now the bonds in Europe, bond yields in Europe and the UK are actually blowing out today, 11 basis points higher on the longer dated gilts, what we call longer dated bonds in the UK.
Yeah, and I mean, the three biggest regions for this, right, are the UK, Europe broadly, and Japan. And so you're seeing, I think we have a chart of JGB yields too over the course of the last several weeks have moved higher materially too. So yeah, these regions have to import more expensive energy in dollars as the dollar is rallying. And part of the reason behind the dollar rally has been the US economy's outperformance versus the rest of the world. Also, the relative yield advantages of investing in duration securities in the US versus the rest of the world, best companies versus the rest of the world. And so there's been a flood of money that continue, the Trump win has inspired investors to bring money back to America. So you have this environment where you've had strong dollar, higher yields, which really puts pressure on these energy importing regions like Japan, like Europe, like the UK, and kind of is starting to lead to a bit of a reflexive negative feedback loop where the more yields move higher, the more the dollar rallies and drives up energy, the more imported inflation that goes on, the more that these countries then have to sell their U.S. Treasury holdings, right? Japan is still the largest holder of Treasury securities. And so they have to sell those securities to raise the dollars to buy the energy, which puts more pressure on bonds, forcing yields higher. So we're kind of getting into this negative feedback loop environment where higher yields, higher dollar, strong energy is starting to stall out economic momentum outside of the U.S. Is starting to.
And remember, Craig, there's 70 trillion of GDP outside the United States of America. There's only 30 trillion in, right? So when this dollar punches the 70 trillion of GDP in the face, okay, that has major, major implications. So if you're on the Trump team Treasury, if you're at the Fed, right now they're getting phone calls from Treasury officials around the world. They're getting calls from government officials around the world. The dollar is causing a lot of pain globally. And that feedback loop is very powerful. And we saw this in 2016. Remember, 2016, 17, the dollar ripped after Trump won. That kills, by the way, this dollar is crushing Trump's base. All those blue collar workers in Pennsylvania, Michigan, Wisconsin, stronger dollar makes manufacturing jobs and U.S. products much more expensive overseas. At the end of the day, we're near a breaking point where we're exporting inflation violently to the rest of the world. We're crushing that 70 trillion of GDP outside the United States versus 30 trillion in. And there's this negative feedback loop, like you said, that's speeding up. Next chart, Jose. See, that would be what, Craig, that's my whole point. That's what would break. That's what would break the dollar.
And look, and what you have, and I listened to Trump's press conference yesterday, which look, I mean, obviously there's a lot in there, which is blustering, and the stuff about Greenland and the Panama Canal and Canada becoming the 51st state and the like. But I think underneath it all is in my view, and I wrote a post about this too, is Trump he's employing an America first, America only policy, right? We've been in his mind, the rest of the world's been ripping off America by, forcing us to protect them, and we pay for the military, and we pay for our military to protect them, and they don't give us anything in return. All they give, they send us their cheap goods, which has hollowed out our manufacturing base. And so, in Trump's mind, I'm sick of it, and it's going to stop, and I'm going to tariff everybody. And I'm going to tax, the rest of the world in order to basically reshuffle the global monetary order. And so, that's kind of what he's talking about. And so the environment that we're in now is the dollar rallying is a reaction to that rhetoric. And these other countries are basically kind of under the gun here, and they need to decide. They'll have to decide when he gets into office, how are they going to deal with him?
And Craig, what's this chart? It's not labeled.
This was the gilt yield chart. This was just
That the UK 10.
This is the UK 10-year yields up 11 basis points today to basically multi-year highs. We're at higher yields now than the quote Liz Truss moment from a couple of years ago, where her policies looked to kind of blow out the deficit and led to a bit of a pension crisis in the UK. We're at higher yields now in the UK than we were before. And so the rest of the world is going to have to negotiate with Trump. And so they're allowing the markets are trading, and these countries are allowing their currencies to weaken in anticipation of striking a larger deal with Trump. You're better off allowing your currency to weaken now, because in the future, when you deal with Trump, he's going to want a weaker currency in order to reshore manufacturing in America and bring jobs back to the US. Trump ultimately wants a weaker dollar, but he's not in there yet. And so we're kind of in this phase where the dollar's rallying aggressively, and Trump is accelerating that rally by his rhetoric. Besson has talked about this idea that part of the reason he wanted to become Treasury Secretary is because he sees a global monetary system reordering that is going to be necessary, and he wants to be a part of it, right? I mean, he's been quoted as he's written about this, in his investor letters from last year, that he wanted to be a part of it. So I think we recognize that a restructuring of the global monetary system is coming. Typically, these things happen under periods of duress and strain and risk asset corrections, not just kind of happen on their own. And so I think the pathway to getting this reordering or restructuring where the dollar is revalued lower and manufacturing can come back here, only happens when a risk asset correction happens first. And so I think we're starting to sow the seeds of that risk correction. We've started to get more negative on risk assets over the course of the last couple of weeks. I know we put out some trading recommendations, kind of short, some NASDAQ and some other type of things. We're also getting a little more constructive on gold, which I think is going to be playing an increased role in this new monetary order. And we've talked about buying back into some of the longer dated duration fixed income securities. So we're starting to prepare clients and hear from clients and talk about that, kind of getting more, of a risk off posture, as we start 2025.
Yeah, because if you're Trump, at the end of the day, you lost the midterms in 2018. Speaker Ryan and Mitch McConnell moved healthcare in front of Trump's agenda. He got destroyed in the midterms. In Trump's mind, and we know a lot of people that are very close to Trump, in Trump's mind, he was impeached twice because he lost the midterms. And so if you think of like the midterms in 2026, they're going to try to take as much pain as possible early on and make the fixes with tariffs, with all the necessary things, with terming out the debt, all the things that they're going to have to do that take some pain. And then by the midterms, or at least by the end of the term, which would be obviously J.D. Vance's time, then all of a sudden you're setting up for the next election. One thing I would say about Trump too is, he enjoys irritating what he calls the Trump deranged. Like he wants people talking about him. And what we learned, and we did this with our clients in 2016. What we did was we traded against the noise. And at the end of the day, the bluff and the bluster is a lot more. It's a lot scarier to investors than the reality. So if you bought into a lot of these bluster victims of 2016, like Mexican equities, a couple of years later, 3 or 4, you're up like 40%, 100%. So a lot of times these trades, he wants two things. He wants people talking about him at the dinner table. He wants to outrage his enemies, and he also wants, Joe Lunchpail, Republican, Ronald Reagan type Republican. He wants them to know that the United States is putting their foot back in the world and trying to make a bigger stamp and America first, the whole thing. So it's like a combination of things, but you can trade. I think you're much better off buying, just look at the dollar in 2016, like I said earlier. The dollar ripped, and by the end of 2000, I think it was 17, 18, the dollar was 9% lower. Yeah. So there was a lot of bluster, and that's what we got to get ready for. Any more slides to say?
No, I think you're right. I think ultimately what you're articulating is we know the ultimate destination for the currency from a Trump perspective is a weaker dollar, right? It's conditional on his campaign, his success. His ability to win the midterms and have, J.D. Vance win in 2028 is conditional on a recovering America, becoming a manufacturing, presence again, where we're making things here. We're no longer importing things from China to the degree we had been, which really screwed us during COVID. We're making all of our critical supply chain elements here. In order to do that, we need a materially weaker dollar. In order to get a materially weaker dollar, we need to have a currency realignment, some sort of grand bargain, right? There's been some talk about a Mar-a-Lago Accord, right? Not surprisingly, it's going to happen at a Trump hotel, right? Or a Trump residence, right? That's a name thing for him. So that's the ultimate destination. And so trading with that in mind, I think, is very helpful. As the dollar gets incredibly overbought, which we're getting very close to that point, these are the times to be thinking about trading against the grain, right? Trading into that ultimate destination. So we added gold miners and some weak dollar plays towards the end of December and early parts of this year, because we're anticipating that that's where we're going to be, or where the country needs to be a year from now. So that's kind of how we think about, our trading framework, kind of multi-quarter outlook out. But we want to be cognizant of some of the shorter term issues and trading dynamics as well, and maybe hedge around those larger decisions, right, into macro events, into payrolls on Friday, or into Fed meetings. And so that's what we're trying to help our clients, do throughout this process.
And Craig, so bond yields, and so think of like fourth quarter, and we'll wrap it up with this. Fourth quarter 21 into 22. Fourth quarter 2021 into 22. There was a lot of complacency in the market on equities. The bulls versus bears were off the charts. Late 21, there was tremendous complacency on inflation. Janet Yellen lectured us, and Powell lectured us again around transitory inflation. They had everybody bought in to that they had transitory inflation. And so inflation was sticky and then got violent in 22. As you can see here, bonds, the TLT in 22 there bottomed. But what's amazing is, look at how bonds, so this TLT is going down as bond yields going up. So that's TLT is basically a representation of bonds. So bond prices going down with stocks from late 21 into 22. Now we have here a similar move down in bond prices, move up in yields. And equities have been just amazingly resilient. Is it complacency in the sense that, like, okay, stocks still don't believe that inflation is sticky? Like, what's behind the kind of this divergence in the chart? I mean, those jaws are those jaws going to meet up soon?
Yeah, look. I mean, I think if we obviously have the chart here is the S&P versus the TLT, but and it's not as if the higher bond yields have not been as impacted in the SPX index, which is a U.S. large cap, now increasingly Mag 7 dominated index, right? And so other indexes, let's put that up against the emerging market ETF, there's been pain there, right? If you put up against some of the whether it's the
KRE dropped 15%.
Yeah, so they're the segments of the sectors where higher yields are more impactful have started to notice. And so, look, I think we are getting very close, and with 10 with 30-year yields kind of we're a whisker from 5% today. I know I saw 20-year yields were about I think actually had a 5 handle this morning. And so we are getting very close to the point where all equities are going to start to notice these higher yields. And so because it is going to impact the economy, right? It's already starting to impact global manufacturing. I mean, global manufacturing PMIs in December were atrocious, not just in the U.S. but globally. And so we're going to see more of a growth slowdown. China's had its growth issues, and the stimulus from China just hasn't happened yet. We expect it to come as they start to negotiate with Trump, but it's not there yet. And so wait
a minute, Greg. The U.S. economy, it's not on Mars. It's actually on planet Earth. So the U.S. economy is surrounded by 70 trillion of economic activity outside the United States, 30 trillion in. So if the U.S. economy was on Mars, then the strong dollar wouldn't matter.
Sure. That's right. So we're getting, we're going to start getting to that. I mean, look, the December data had, some of the Trump bump into it. Obviously, a big payrolls released this Friday. But I think as we start to transition into, later part of this quarter and throughout this year, the impact of the higher yields that we've seen over the course of the last 3 months are starting to be, will start to be noticed, right? 30-year mortgages above 7%, credit card loans moving back higher again, auto loan rates moving back higher again. So, that's going to start impacting, retail sentiment and consumer sentiment, in the coming months and quarters. And so, I expect that'll hit earnings, that'll hit multiples, and that's kind of how you start to bring down, equity prices to alleviate some of this jaws of death chart we got here.
Think of Microsoft, right? It's number 2 stock in the S&P, almost 7% of the S&P, something like that. Microsoft, 50% of their sales are outside the United States. So as the dollar rips higher, their products are becoming more and more and more and more expensive. At the same time, Microsoft is spending, and this is one thing I'm gathering from the clients around the world. Microsoft's spending close to 30% of their revenues, $80 billion, 30% of their revenues on artificial intelligence CapEx. So companies like Microsoft, what they're doing is these Mag 7 companies, they're doing this massive capital expenditure, right? So CapEx is exploding. $80 billion of investments in artificial intelligence just from Microsoft alone in 2025. So think about this. What they've been doing, they did this last year. What they do is they're spending the money and they're depreciating. So it's going to basically hit earnings later this year, next year, because these are companies that were massively capital, like cash cows. They produce dividends, they produce lots of cash. Their cash grew on the balance sheet. Now they're spending, just Microsoft alone, $80 billion. So you have to ask yourself, you got a dollar ripping with 50% of your sales of Microsoft outside the United States of America. At the same time, your earnings are going to be impacted by this massive, all these Mag 7 companies, they get guns. It's like a scene from The Sopranos. They get the guns at each other's heads. They're all trying to outspend each other. And there's no visibility on return on invested capital. So that's another thing that's going on in the market, where these are incredible investments, data centers around the United States, around the world, $80 billion, 30% of Microsoft's sales, which is just an obscene number, are going to investments. That hits earnings in late 25, 26, like we've never had it hit before. At the same time, you get the dollar hitting. So these are the things that we're talking about with the bear trap. So once again, we run a institutional chat on Bloomberg with hedge funds, mutual funds, and pension funds. We run the Discord chat with high net worth individuals and families. Join us at thebeartrapsupport.com, Tatiana at thebeartrapsupport.com. Get live, get on the team. Have a great 2025. We're going to see you soon. Any closing comments, Craig?
No, I think I think you nailed it there. I mean, it's looks like it's going to be a very active start to the year. I think a lot of these trends that were maybe dormant at the end of December because it was holidays and people weren't focused on what was going on, I think are starting to come front and center. And Trump takes power in 12, 13 days or so. And look, we've already seen, right? I mean, Trump tweets in the middle of the night, articles come out all times, right? Volatility as an asset class is going to be more bid than it had been under Biden, because you have to kind of be prepared for something that he might do overnight, right?
The middle of the night Trump.
The middle of the night tweets about tariffs or about, a great phone call with Xi, or is he going to do something in Iran, right? These are risks that are back in the fold that investors have become incredibly complacent about under the Biden administration, because he did things more traditionally, right? So you were able to hedge portfolios into known events. Trump's a little bit more of an unknown entity in those regards from the timing perspective. So you kind of have to think about your portfolio and hedge your portfolio out in a little bit more duration. I think volatility as an asset class, this year is going to look, is a great place to be, to kind of remain protected. And that's courtesy of, Trump 2.0.
Yeah. All right. Well, thanks so much, everyone. We'll see you soon. The Bear Trap Support. Thanks, Craig Shapiro. And we'll see you at the top. Thank you very much.
Thanks.